Okay, Chapter 5. Now in Chapter 5, we're going to be looking at the consolidated financial statements, but from the perspective of intra-entity transactions regarding assets. What does this mean? The parent and the subsidiary are conducting transactions among each other in the asset area. And the key areas we're going to focus on are inventory, land sales to each other, and depreciable asset sales to one another. And the special accounting we need to concern ourselves with each of those types of transactions. So when affiliated companies through common control engage in intra-entity inventory transfers, consolidation procedures are required to eliminate the sales and purchases balances, because you would be reporting twice as much revenue, twice as much expense, basically of the same amount. So transactions between its parent and subsidiary are considered internal transactions of a single entity. So in other words, if a parent sells to a subsidiary, they're going to increase their sales amount. But in the same respect, the subsidiary will also have a transaction, and when they sell the goods, they will also have a sales revenue amount. So the point of this is we need to eliminate those types of transactions among the parent and the subsidiary so we don't count that sale twice. And furthermore, so that we only really truly record the gross profit related to the ultimate sale to an outside party. And that's the guts of this. So the effects of intra-entity transactions need to be eliminated before we can prepare the consolidated financial statements. And as I said, here's the guts of it, and this is what you always have to remember. Our consolidated revenues and expenses and inventory and etc. must reflect only transactions with outside parties. Let's look at a quick example. This will now be considered entry TI, transferred inventory. How do we eliminate this intra-entity transfer? Eliminate all intra-entity sales and purchases of inventory by eliminating the sale price of the transfer, which one company records as sales and the other records as cost of goods sold. So if we turn, let me get to my chapter 5 here, to page, we need to understand this beginning because it's going to get a little bit more, not hard, but we're going to add some more into the fluff here so that you really understand what's going on. Take a look on page 200. It says to account for related companies as a single economic entity requires eliminating all intra-entity sales and purchase balance, just like we said. For example, if Arlington Company makes an $80,000 inventory sale to Zirkin Company, an affiliated party, within a business combination, both parties record the transfer in their internal records as a normal sale/purchase. So, the following consolidated worksheet entry is necessary to remove the resulting balances from the externally reported figures. Cost of goods sold is reduced here under the assumption that the purchases account usually is closed out prior to the consolidation process. And that's key. So to the parent who sold the $80,000, that's a sale. Eliminate that. It's not a true sale. And then eliminate from the purchases account the purchase of the inventory. It's as if the parent never sold the inventory to the subsidiary. Okay? And so these transactions, it doesn't matter if it's the parent sold to the subsidiary or if the subsidiary sold to the parent. Now, that's assuming, number one, that the parent sold at the original cost, okay, to the subsidiary. And also that all of it was sold by the end of the year. So we kept it simple. Let's kick it up a notch now, right? Despite entry TI, transfer of inventory, ending inventory may still be overstated due to the transfer price exceeding historical cost. So intra-entity profits that remain unrealized at the end of the year must be removed in arriving at consolidated figures. We dealt with this under the entity of the equity method, right? So if an intracompany inventory transfer occurred and any of that inventory is still on hand, only the inventory that is actually sold should show gross profit. The inventory that's still on hand is unrealized gross profit and must be eliminated. So the consolidated company has earned the profit on any portion of the intra-entity transaction that was sold to unrelated parties. We don't include that here. It only makes the adjustment for the part that remains at the end of the year. Now, take a look on page 201. All inventory remains at year end. Let's look at an example here. In the preceding illustration, Arlington acquired or produced this inventory at a cost of $50,000 and then sold it to Zirkin, an affiliated company, at the indicated $80,000 price. Now, remember the prior example, they made it for $80,000 and they sold it to the subsidiary for $80,000. In this case, the parent is selling to the subsidiary and actually recording a gross profit. No, not a gross profit if the subsidiary has not, and the subsidiary in this case being Zirkin, has not sold it to an outside party, and that's what we're saying here. All inventory remains at year end. So when the parent records this sale, what are they doing? They're debiting sales, or I'm sorry, probably like an accounts receivable and a sales amount, and they're debiting cost of goods sold and crediting inventory. Well, you removed the sale portion in that first entry we just did, inventory transfer. But what about the gross profit here? Because the sale amount the parent records is $80,000. The cost of goods sold portion will be $50,000. On their individual records, they're recording a $30,000 increase in gross profit from this intra-company sale. You're not allowed. The parent can only show in the consolidated statement gross profit when the subsidiary actually sells that inventory outside the company. So journal entry TI solves this. So that's down at the bottom of the page on 201, you'll see. They're going to debit cost of goods sold, increase cost of goods sold, $30,000. If all the inventory has not been sold yet by the subsidiary, and credit inventory $30,000. Because gross profit would be overstated and inventory would be overstated. Now that's assuming here that all the inventory remains at the end of the year that was sold intra-company. Okay. And there's an example of the journal entry again. Okay. That's entry G. Now, that was entry G on the previous one. We're going to handle this entry in a second because this is where we're going to kick it up another notch, throw some spice in. We handled in our prior transaction what happens if all the inventory remains. Okay, we have to remove all the gross profit off the consolidated statement. Single, individually, yeah, the parent had a $30,000 gross profit. But in a consolidated financial statement? No, they didn't, because all the inventory remains at the subsidiary. Now, what happens if only a portion of the inventory remains? Then only a portion of the gross profit that still remains must be removed in consolidation. So you would do that same journal entry, debiting cost of goods sold and crediting inventory, but only for the amount of gross profit that should not be recognized because the inventory is still there. If you look on the bottom of page 202, that gives you an illustration of that. To illustrate, assume Arlington transferred inventory costing $50,000 to Zircon, again for 80 grand. There you go. Gross profit on Arlington's book will be 30,000 on their individual. Assume further that by year end, Zircon has resold 60,000 of these goods to unrelated parties, but retains the other $20,000. From the viewpoint of the consolidated company, it has now earned the profit on only 60,000 of the 80,000 original sale. So, go to the next paragraph. Any gross profit recorded in connection with the 20,000 in merchandise that still remains is still a component within Zircon's inventory account. Because the gross profit rate was 37.5%, how do we get that? The original gross profit was 30,000 divided by 80,000. Remember, that's being recorded on the parent's books. Only a portion of that can stay there. The other has to be eliminated. This retained inventory is stated at a value of $7,500. The $20,000 sale value times 37.5%. So when some of the inventory is still there, only a portion of the gross profit needs to be eliminated, and that's what you see at the top of page 203. Okay, so in the year of the sale, that's what we have to look at. What inventory remains? Now, going forward into the next year, from a consolidated view, so when you add in year 2, when you do all of your consolidation, the buyer's cost of goods sold, so the beginning inventory component, and the seller's retained earnings accounts contain the unrealized profit and must both be reduced in entry *G. So what we do is, at the end of year 2, we debit retained earnings and credit cost of goods sold for the amount of the gross profit that was not realized last year. Why? Because within the individual company statements, remember last year, the individual company statements, the gross profit was already recognized by the parent and it was closed out to retained earnings. Well, by the end of year 2, that inventory is sold. So that portion of the gross profit must be recognized now. So we'll reduce retained earnings because there's too much in retained earnings for a consolidated view, and there's too much in cost of goods sold. We need to reduce cost of goods sold by that $7,500. Okay, so essentially we're recognizing now in consolidation the amount of the gross profit we couldn't last year. And we have to do this journal entry because on an individual company basis, that whole 30,000 was already recorded and closed out to retained earnings. We're just going to take it out of retained earnings and put it in as a gross profit in consolidation. Remember, this is not affecting the individual company's books. This is a consolidation entry. So, for intra-entity beginning inventory profits resulting from downstream transfers when the parent applies the equity method. So we're going into page 204. Parents' retained earnings are appropriately stated due to intra-entity profit deferrals and recognition. So if the parent is using the equity method, they aren't recognizing that profit. During the year, they're changing their investment account for that unrealized gross profit and reducing their revenue in a true equity method. So the individual parent will be okay. The subsidiary's retained earnings reflect none of the intra-entity profit and require no adjustment. The parent's investment account at the beginning of year 2 contains a credit from last year's unrealized profit. So that entry, the asterisk G, transfers the year 1 investment account credit to year 2 earnings credit via cost of goods sold. So what they're saying here is if this is a downstream transfer and the parent uses the equity method, we would be debiting the investment in subsidiary in year 2 for this journal entry and crediting cost of goods sold in the elimination for the end of year 2. I know this is getting funky, but this is what happens. So we need to know how much inventory was unrealized as far as gross profit goes in the prior year. How does the parent account for the investment? In the prior journal entry, we used retained earnings. But when it's a downstream, that's more of an upstream. In downstream, since these transactions throughout the year directly affect the investment account, this is when we will be fixing them. Now, worksheet entries to eliminate your sales and purchase balance, entry TI, transfer of inventory, and to remove unrealized gross profit from ending inventory in year 1, entry G, are standard, regardless of the circumstances of the consolidation. So whether the transfer was upstream, downstream, doesn't matter. You're going to do those 2 entries every year. But the procedure to eliminate intra-entity gross profit from years 2 beginning account balances differs. So if the original transfer is downstream, the parent sold to the subsidiary, and the parent applies the equity method, that's what we're talking about. If the transfer of inventory is downstream and the parent uses the equity method, we will debit the investment account and credit costs of goods sold, as we saw on page 204, to realize now the unrealized gross profit from last year. Remember, this is the year 2 entry. It has a little asterisk G. Investment in subsidiary account would replace retained earnings account used for upstream sales. Now, why is that? Well, because the subsidiary, if they sell upstream to the parent, what do? The same type of journal entry. They credit sales, they debit cost of goods sold, they have a $30,000 gross profit. Well, if the parent still has some of the inventory left over at the end of the first year, what happens in the second year? Well, what did the subsidiary do with that $30,000? They closed it to retained earnings. And because of that, they don't do any kind of entries under the equity method like the parent does. So we need to do that original journal entry where you saw the debit to retained earnings and credit to cost of goods sold in the elimination. The subsidiary's retained earnings is including the gross profit from last year that we didn't recognize in consolidation. So we need to debit it and properly report it in this year's consolidation. So you got to keep this straight. Individually, the parent is doing their own accounting and the subsidiary is doing their own accounting. It's like they're selling to outside people even when they're selling to one another. But in consolidation, that's when we start looking at this process and going, do we really record all of that? And that's where these come in. Now, accounts affected by intra-entity transactions include revenues, cost of goods sold, and expenses. Also, non-controlling interest in the subsidiary's net income, retained earnings at the beginning of the year, Also, if there's transfers of inventory, land, buildings, and equipment between the parent and the subsidiary, and non-controlling interest in the subsidiary at end of year. So we need to worry about those kind of things when it comes to the non-controlling interest as well, and recording unrealized gross profits. Now they talk about that at the bottom of page 205 and 206 on how it's actually handled. According to the FASB, the amount of intra-entity profit or loss to be eliminated is not affected by the existence of non-controlling interest. So what they're saying here is, you pick. The complete elimination of intra-entity gross profit or loss is consistent with the underlying assumption that consolidated financial statements represent the financial position and operating results of a single entity. The elimination of the intra-entity profit or loss may be allocated, though, proportionately between the parent and the non-controlling interest. So, the FASB is basically saying you could look at it as if it's 100% owned, or you could look at it from the other perspective. And on page 206, they talk about this. And this is the way it's usually handled. If the parent sells, and this is on the third paragraph down, if a transfer is downstream, a logical view would seem to be that the unrealized gross profit is that of the parent company. The parent company does not have a non-controlling interest. So eliminate all the profit, the gross profit, assuming the inventory is still at the subsidiary. However, if the subsidiary sells the inventory to the parent, some of that gross profit should be allocated to the non-controlling interest because they're a party to that subsidiary's income. The subsidiary's financial records would recognize the full gross profit, but what about consolidation? In the textbook, the non-controlling interest share of consolidated net income is based on the reported income of the subsidiary after adjustment for any unrealized upstream gross profits. Upstream meaning because the sale occurred from the subsidiary to the parent. So how does that all jive out here? Well, if the $40,000 unrealized gross profit, because the return to large and small company. If the $40,000 unrealized gross profit, and that's an example up at the top of the page, results from an upstream sale from the subsidiary to the parent, only $60,000 of Small's $100,000 reported income actually has been earned by the end of the year because there's a $40,000 gross profit component. How much should be eliminated of that $40,000? The allocation to the controlling interest of that $40,000 should be $18,000. So in elimination, the other $22,000 would be eliminated. So it all depends on how the inventory was sold. If there's a non-controlling interest. When we first started looking at this, we took it from the perspective of the inventory was owned, or the company was 100% owned. The subsidiary was 100% owned. Now, more of these types of factors make it a little bit more technical. So we need rules and an understanding of them. Now, the next couple pages are great illustration of this intra-entity unrealized profit from downstream and upstream. Under the assumption, and be careful of this, first the parent uses the equity method. The equity method. And then the parent is using the initial value method to account for their investment. And I don't think, let me see if they do the partial equity. I think they did. Remember, well, maybe not. It was the initial value and the equity method. So let's look at an example here. Top company acquires 80% of the voting stock of Bottom Company on January 1, 2012. So their first year is 2012. Top pays $400,000. The acquisition date fair value of the non-controlling interest is $100,000. Top allocates the entire $50,000 excess fair value over book value to a database that has a 20-year remaining life. Now, the subsidiary reports net income of $30,000 in 2012 and $70,000 in 2013. Now, the illustration in your book will be for December 31st, 2013. And right now I'm looking at page 210. Dividend payments are $20,000 in the first year, $50,000 in the second year. There is a debt between the two companies of $10,000. And here's the inventory transfers between the two companies, assuming a downstream, parent sold to the subsidiary. During 2012, the parent sold, charging the subsidiary $80,000, but the inventory had a cost of $60,000. So their gross profit was $20,000. The year-end inventory balance, the amount remaining, is $16,000. So the gross profit percentage that will be for unrealized profit, $4,000. In 2013, the parent sold to the subsidiary for $100,000 inventory that cost them $70,000. The parent has a profit on their books this year in 2013 of $30,000. $20,000 of that inventory remains at the end of year 2. That is a 30% gross profit. So the amount of gross profit that should not be recognized by the end of the year is $6,000. Okay. So, what entries need to be done? Well, they do go through our normal entries. T1. Okay, so first of all, on page 209, your PowerPoint just skipped right to the asterisk for the second year. So, I'm sorry, in T1, in year 2, we have to eliminate that sale. So we're going to debit sales, credit cost of goods sold or inventory wherever the subsidiary reported that $100,000. Entry G. We need to eliminate the part of the gross profit should not be recognized this year from the elimination. So we're going to debit cost of goods sold, increasing the expense, and credit inventory. Now, what else needs to be done? At the end also, so that $6,000, remember, represents the amount that was unrealized last year. Well, it needs to be realized this year. And it's not physically on the parent's books anymore. That was handled last year on the parent's books. Where was it handled? I'm sorry. I'm so sorry. I'm jumping ahead because I'm looking at asterisk G. Now, that was on this year's book, so we need to eliminate it. Now, how do we handle last year's unrealized gross profit? Well, we're going to increase the investment in bottom because the parent is using the equity method. So they have a decrease right now in their investment account for the part of the unrealized profit that they weren't recognizing from last year. We'll increase it and then decrease cost of goods sold in elimination. So we're going to show that $4,000 profit in consolidation. In consolidation this year that was not allowed last year. Was reported on the parent's books last year, but we need to get it recorded this year in consolidation. Now, what happens when it's the opposite? There's your your transfer of inventory, just like before. And also, we do the same journal entry. Remember we said if the transfer is upstream or downstream, these first two entries are the same. Remove the sales and cost of goods sold in the consolidation process, and then debit cost of goods sold, credit inventory for the unrealized gross profit for this year. But what about last year's gross profit that was not realized? And of course, okay. Okay. Here. Entry G reduces bottom's beginning 2013 retained earnings balances and decreases cost sold. And there it is. Gosh, I gave you 4 slides on that. As of January 1, 2013, we need to debit the retained earnings because right now in the subsidiaries retained earnings beginning balance, they have that $4,000 from last year. And if you said, well, we eliminate it. Yeah, we eliminated it on a worksheet. We didn't eliminate it out of bottoms, the subsidiaries' actual retained earnings. We're doing that now in our second year of consolidation. And we'll credit cost of goods sold. Now we could recognize that. So the difference there is between how the inventory was transferred. There it is again. Downstream, upstream. Now, entry S eliminates a portion of the parent's investment account and provides the initial non-controlling interest balance. And we've done that in previous chapters. So the entry also removes stockholders' equity accounts of the subsidiary as of the beginning of the current year. So if you're looking at the downstream, and I believe that's, oh, this is the upstream worksheet. Go to page 213 and we'll show you how they got these numbers. 150,000 was the common stock of the subsidiary. 310 less the $4,000 retained earnings adjustment. So you need to take that into account before eliminating the subsidiary's retained earnings. That's key. So that asterisk G, must do that first before you remove and take out the retained earnings balance of the subsidiary. Then 80% is allocated to bottom and 20% to the non-controlling interest. Now, the downstream transfer, if you flip back to that on page 210, you don't have to do any kind of business with the retained earnings of the subsidiaries. So you use the balance of their account, debit that to eliminate it, debit the common stock account for the subsidiaries balance, and then 80% would be distributed to the investment account and 20% to the non-controlling interest. Okay, so that is how we handle inventory. I strongly urge you to really read through those pages for upstream and downstream transfers and these new entries and post any kind of questions you have. What we're going to do now is move on to land transfers between a subsidiary and a parent. This is starting on page 220. If land is transferred between the parent and subsidiary at a gain, so it's a downstream or upstream, the gain is considered unrealized and must be eliminated. Not until that land is sold to an outside party is any of that gross profit ever recognized. So here's the deal with this entry. That land may never be sold to an outside party. So you got to do this entry every year. Well, it'll change up a little bit from the initial sales year till the future year, but you have to. And there's how you do it. Debit the gain on sale of land, credit land. So, take a look on page 221. Here, Hastings sold land that originally cost $60,000 to Patrick at $100,000. So, what we are really going to achieve here is to act like we never sold the land. Because now Patrick will record it on their books, Hastings will record it on their books. Okay, remember individually they're going to record it, but in elimination we've got to remove the effects on their individual books so that in consolidation it's like the land was never sold. So in the first year, entry TL, page 221, that's what we do. We debit gain on sale of land, credit land for the initial sale. Now, if you're sitting there going, I don't get that. Well, think about what happens in the initial year of sale. Hastings is going to debit cash, credit land, and credit gain on sale of land. Right? So they're going to reduce their land 60,000 and record a gain of 40,000. What is Patrick going to do? Patrick is going to debit land for 100,000 and credit cash. Okay? We need, in consolidation, the land account, if we did no type of elimination here, would have a balance what am I doing here? 100,000. Land 100,000. Yes. Would have a balance of 100,000 because Hastings took out all their land. Their land account is a zero balance. Patrick has a $100,000 land balance. Swing that across on your worksheet. Looks like you bought land for $100,000. No. This wasn't a sale and it wasn't a purchase. So we need to debit gain on sale of land 40,000 and credit the land account, and when we swing that across, the land balance will be 60,000, the original. Now, as long as the land remains on the books of whoever bought it without selling it, the year 2 and going forward will be entry *GL. Now in the first year, the gain on sale of land is actually on the income statement, so that's why we debit that account. But what happens to that gain on sale of land? Well, it gets closed out to retained earnings. So in consolidation, our retained earnings account is always overstated if we don't take that $40,000 out of there in each year going forward until we actually sell the land to an outside party. So we'll be debiting retained earnings and crediting land for that $40,000. So in the period the land is sold to a third party, the unrealized gain must be eliminated one more time and also finally recognized as a realized gain in the current period's consolidated financial statements. So we're still going to debit retained earnings, but we'll be crediting gain on sale of land in consolidation. So the individual companies will be fine. That will be a consolidation journal entry in the year of sale, and then it will now be shown as a gain on the sale of land. And you will see that at the top of page 222. Now, the effect of land transfers. Downstreams have no effect on non-controlling interest. Upstream does. Transfers have a gain on the subsidiary books. So if it's upstream, the non-controlling interest balances are based on the sub's net income, excluding the intra-entity gain. So you could take a look and read through that. I'm moving on to depreciable assets. I'm just giving you the guts. When it comes to a company selling to its subsidiary or vice versa, depreciable assets, there's a couple things we need to worry about. So we're going to set you up with an example. Able Company and Baker are related. Able purchased equipment for $100,000 several years ago and has recorded $40,000 of depreciation since that time. So this is important. Right now, that book value of that equipment is $60,000 BV. Baker buys the equipment from Able for $90,000 on 1/1/12. So they pay 90, where the book value was 60. So, and the equipment has a remaining useful life of 10 years. So what's going to happen here? Able is going to have a $30,000 gross profit on their individual books. Not going to have this equipment on their books anymore, but Baker will now have an asset that is going to depreciate for 10 years that costs $90,000. So if we take that $90,000 divided by 10 years, it's going to be recording $9,000 in depreciation expense each year. So all the activity after year 1 is happening on Baker. They're going to be recording depreciation. In year well, actually year one, they're going to have that. And Able will have in year one a $30,000 gross profit. How do we handle this? Well, first of all, and there's what I was just talking about. We have to act as if the seller never sold it. Okay? What's happening though on their individual books? Well, the seller here, I think it was Able, has a $30,000 gross profit on their books. On the buyer's books, and they would have, what would they have had if they didn't sell this? They would have recorded depreciation of $6,000. On the buyer's books, they now have an equipment asset at a cost of $90,000, and the buyer will be recording $9,000 per year on their individual books. We have to eliminate all that stuff so that it's like they never sold it. That's where it gets. So in the year of transfer an asset, in the year of transfer, here's entry TA. Unrealized gain must be eliminated and the assets restated to original historical cost. So what does that mean? Well, remember, what did the parent do when they sold this, or whoever? What did Able do? Able credited equipment for $100,000. They debited accumulated depreciation for $40,000 and recorded a gain. What did Baker do? They debited equipment for $90,000. Well, what we have to do is get the equipment back up to the original cost of $10,000 in elimination. So the balance of equipment on Able is 0. The balance on Baker is $90,000. So in this entry needs to increase the equipment account $10,000. There's no accumulated depreciation recorded anywhere on the parents or the because the parent took it off when it sold it, or the subsidiaries books. We need to restate or put that accumulated depreciation back on by crediting accumulated depreciation. And then we need to eliminate that unrealized profit, because we don't realize profit until it's sold to a third party, just like the land. So and for this consolidation entry, you'll be debiting gain on sale of equipment. Now, in addition, the buyer's depreciation is based on this inflated transfer price. The excess depreciation expense must be eliminated. There should only be depreciation expense in consolidation as if the sale never occurred. We said the parent, Able, was recording $6,000 in depreciation each year. They don't have anything on their books this year. Individually, the subsidiary has $9,000, $3,000 more than what was originally usually recorded for this. So what we have to do, debit accumulated depreciation, credit depreciation expense in consolidation to remove the effects of the excess depreciation based on the sale that shouldn't even be recorded as a sale in consolidation. Now, in years following the transfer, equipment is carried on the individual books at a different amount than on the consolidated books. The amounts change each year as depreciation is computed. So to get the worksheet adjustment, you need to compare the individual records to the consolidated record. For instance, the parent should have the records should be for the equipment cost should be $100,000, and that's what the consolidated perspective is saying. It's right now only at $90,000 because the subsidiary hasn't recorded what it originally bought it at. So the entry for consolidation will be a $10,000 increase to the equipment. The accumulated depreciation account on the books of the company that bought it is $18,000. First year $9,000, second year $9,000. So total depreciation, accumulated depreciation in this case, is $18,000. How much should be in that account as if the company never sold it? Well, it started when the company sold, when Able sold it to Baker, it had a $40,000 balance. Well, we would have recorded $6,000 last year and $6,000 this year of depreciation. So the balance should be $52,000. So you need to increase accumulated depreciation $34,000. Depreciation expense right now stands at $9,000. It should only be $6,000. So you need to decrease depreciation $3,000. And then your offset will be the balance of retained earnings. Retained earnings, the original gain was $30,000 on able sellers' books, less the $9,000 plus the $6,000. Okay, so the balance, well, let's say here, that $21,000 represents, I'm sorry, the individual records in the beginning balance of the subsidiary. Not the subsidiary, this is Abel's books. I apologize, I'm getting myself all jazzed up here. But as of 1/1/13, Abel's individual records show a $30,000 positive profit in the retained earnings minus from $9,000. Okay. So $21,000, it's not Abel's, it's Abel's and Baker's added together. The individual records, the beginning balance of retained earnings for Baker and Abel added together have an effect from this transaction of $21,000 positive. So there's more in retained earnings when you combine those two than there should be. Why? $30,000 is on Abel's books. That shouldn't be there. And Baker has $9,000 more in depreciation than they should have. What should be in there, or retained earnings should have only been decreased by $6,000 of depreciation from last year. I hope that makes sense. So what do we have to do? Increase, or we have to eliminate, eliminate yes, $27,000. So that will be your journal entry for moving forward. I'm telling you, it does get kind of crazy, but we need to learn this and we need to keep it straight. So when it goes into the future years, you really need to look at what are the individual records stating, what should they state? And the consolidated perspective is we never sold it. If we never sold this, how would this equipment be represented in consolidation? And then based on the differences between those two, you will then do an adjustment. So there's some more information. And there is the adjustment to fixed assets and depreciation expense must be made in each succeeding year as stated. There is your entry ED, subsequent years. So excess depreciation. So every year you're going to be debiting accumulated depreciation, crediting depreciation expense, and consolidation, because the subsidiaries reporting $9,000 should only be reporting $6,000 in consolidation. Now, if the transfer is downstream and the parent uses the equity method, then their retained earnings balance has already been reduced for the gain, and we would adjust the inventory account instead in that subsequent year. So it depends on how the parent accounts for the investment itself, because all of these unrealized profits would be directly recorded and change the investment account. And that's the key here. Or if the parent chooses not to use the equity method, or it's an upstream transaction, we would use retained earnings in this future year after transfer. So it gets crazy, doesn't it? Transfers of assets among related parties are common though. Here's the key. Inventory transfers are the most prevalent form of intra-entity asset transactions. Despite being only a transfer, one company does record a sale while the other reports a purchase. Those need to be eliminated in consolidation, or else we would overstate that information. Also, we need to remove any unrealized profit on any of the inventory that has not been sold. And depending on how the inventory was originally sold, upstream or downstream, will dictate how we complete those journal entries. Also, any past year unrealized profit will now be recognized in consolidation. And we looked at that, asterisk G, I think it was. Transfers of depreciable assets create the additional accounting issues because of depreciation expense. Remember, the key is for land and depreciable asset transfers, we need to pretend, and in consolidation, report the asset as if it was never sold. So all the effects from the sale of those transactions between the two companies must be eliminated during consolidation. So take a look through your chapter. If you have any questions, you could post them out to the discussion board.